Would you rather pay low tax rates on less money today or wait and pay higher tax rates on a larger sum of money later? Think. In this educational episode, I'm going to talk about why you should not kick yourself for waiting, putting off, deferring paying tax on your IRAs and 401ks, 457s, 403bs, your qualified accounts to some future perceived unknown advantage, and then withdraw your money when actually taxes will be higher and account values will be higher. So I want you to rethink your thinking. Get ready and you'll understand why. So I'm Doug Andrew. I've been a financial strategist, a retirement planning specialist now for nearly 5 decades, helping thousands of people optimize assets, minimize taxes, but prepare for a comfortable retirement so that at retirement planning, which is different than for retirement planning, we're looking at the big picture. And the most frustrating thing that I see is people being told, I think being duped into thinking that putting their money into tax-deferred IRAs and 401ks is the best strategy. Being told, you'll likely be in a lower tax bracket when you retire. Now, that's what they told us 40 years ago. But more than 25 years ago, that was no longer true or axiomatic, meaning most savers, most people who actually save money and accumulate a respectable retirement nest egg that's big enough that will maintain the same lifestyle they're used to and not outlive their money, they're not in lower tax brackets when they retire. If you don't understand why, even if they have less income, it's because they've been killing their deductions along the way. See, most people in retirement don't have the mortgage interest deductions on their home or their real estate. The children are gone, or if they move back in, you can't deduct them anymore. Most retirees are no longer contributing money to IRAs or 401ks, and so you don't have that deduction anymore. Most business owners are out of their business. They don't have those deductions anymore. So even if you have less income, you're paying as much or more in taxes because you got rid of all those deductions. I have seen this over and over again. And so that's why when the government was hard up for money back in 1997, they were hard up for tax revenue. Senator Roth said, a lot of smart people are realizing they're not going to be in a lower tax bracket. So it would be better if they just got the taxes over and done with sooner than later and enjoy tax-free income. Let's introduce a new strategy and name it after me, a Roth. Okay. Now, a Roth is a step in the right direction, but I've never owned a Roth. I've never owned a traditional IRA or 401k, but I've never owned a Roth IRA or 401k. Why? Well, even though it's a step in the right direction, you're paying tax on the seed money, the contribution, but later on when you harvest your money, it's tax-free. There's still too many strings attached, meaning you can only put in a certain dollar amount or a certain percent of your income. And as of the recording of this episode, President Biden even wants to do away with money being rolled out of traditional IRAs and 401ks into Roths in large lump sums. I don't know why. But that's why Senator Roth did it, because it triggered tax. It created a revenue. And so the government did it for them, not for us. And a lot of people could see that was better to convert, get the taxes over and done with sooner than later in the current tax rates, because they saw that future taxes would likely be higher. Well, you don't have to roll over to a Roth. You can actually get the money out of those IRAs or 401ks and get the taxes over and done with sooner than later, even while your account values are lower, and then ride the market back up again, tax-free. But you don't have to take money out of an IRA or 401k and spend it. You simply take the money out and get the taxes over and done with to the maximum amount in your current tax bracket. And maybe even if you take out another few $100,000 in a given tax year, The most you would pay is maybe another 2% from a 22% tax rate to a 24%. Sometimes you'll be glad that you did that, even though you took yourself to a higher tax bracket. It's not on all your money retroactive back to $1. It's only on the dollars over, 190,000, let's say, in the year 2023, clear up to 380 or 90,000 before you move from 22 to 24 and from 24 to 32. And so what the heck, pay an extra 2%? Because if you put it off, the 24% tax bracket that was initiated by Donald Trump in 2017, they will sunset or expire at the end of 2025. The 24% tax bracket automatically is set to go up to 28%. So why not get taxes over and done with this nearly $400,000 of room of taxable income in a 24% tax bracket than waiting until it goes up to 28%? Hello, that's why I say think. And so I originated the idea years ago of what I call a strategic rollout. Again, it's not a rollover. I'm not telling people to roll money over from a 401k into an IRA and then continue to defer, procrastinate until age 72 and then take RMDs. I created software years ago that would illustrate if people did that. And people were shocked. They would go, well, my accountant says if I'm going to save tax, I should take RMDs. Well, your accountant is myopic, short-sighted. Your accountant is only wanting to save you tax in this given tax year. Let's look at the big picture. So I created this software that would show the darkness of the night if you took RMDs starting at age 72 out to your life expectancy, and then also your spouse's life expectancy, and then left behind to your children, your non-spousal heirs, the remainder. And now they have to get the money out and taxed within 10 years. They can't go out to their life expectancy anymore. The government wants that money out and taxed before you die or within 10 years after your children inherit it, okay? Now, think about it. IRAs and 401ks, they're the best savings bond the government ever came up with for themselves, okay? So let me explain this using a little analogy. So let's say we're going to go into business together and you're my partner and I tell you, listen, we're going to go into this partnership and you're going to do all the work, but I get a third of everything that this business is worth down the road. Do you want to go into a partnership with that? Well, wait a minute here. Here's the other rules. When you get ready to cash in on what you've built this business to, I get a third of everything that you realize from the sale of this business. But if I deem that I'm more hard up than you at that time, I can change my percentage from 33% up to 40%, maybe 50%, maybe even 60%. Let's handshake. Would you go into business with a partner like that? Absolutely not, I hope. What did I just describe to you? An IRA or 401k. See, Uncle Sam is your partner, and Uncle Sam gets to call the shots. They tell you, no, you can't sell that business before age 59 and a half, or else I'll penalize you 10%. But you must sell it by age 72, or I'll penalize you 50%. And if I want, I can change the amount of tax I'm going to charge you from 33% to 40 to 50 to 60% if I deem that I'm more hard up than you. See, I don't want a partner like that, and I hope you wouldn't either. And so don't get in that trap. I would recommend you get your money out of those IRAs or 401ks. Get rid of that partner sooner than later, because sometimes people say, well, why do they tell you on CNBC to do a stretch IRA, postpone till you're 72, and then take RMDs? Why do those advisors tell you to do that? And I simply go, come on. Who's funding CNBC? Tax revenuers. Why would they ever want to kill a partnership where they could continue to get 1/3 or more of everything you will ever make on those IRA or 401k accounts. So think about it. Check out getting your money out of those IRAs or 401ks, performing a strategic rollout. You do that normally over a 5-year period based upon the room in your tax threshold. You then reposition the after-tax money into something that's going to be tax-free from now on. My favorite vehicle that's tax-free is a maximum funded indexed insurance contract, IUL, and it must be structured correctly and funded properly. If so, it will be deemed a laser fund. That's where I have been able to earn an average since 1997 of a little over 11% and netting 10% after the cost of the insurance, which makes it tax-free. So I'm netting 10. I can double my money every 7.2 years. Every $1 million in a portfolio of laser funds can generate $100,000 a year of tax-free income, even if I live to be 120 years old. You show me any IRA or 401k invested in the market that can illustrate a 10% payout to age 120. You will not find it. An advisor is not allowed to even show you that because it's not realistic. So if you want to learn more about strategic rollouts and how you can benefit from doing that yourself, I would recommend that you study the Laser Fund and also the strategies contained in this book. Now, this is my 11th book. It's been flying off of our warehouse shelves. I send out about 250 of these a week. It retails for $20 on Amazon. I will gift you a copy free. To claim your free copy, simply go to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. Now, I'll fire out a hard copy to you via priority mail. There's also options if you like to listen and learn with an audio version, if you like to watch and learn. And there's even educational webinars that we teach on a regular basis. They're free. You can even schedule an appointment with an IUL specialist that can show you how these strategies may apply in your particular set of circumstances. There's no cost or obligation for that free consultation and analysis. This is not about me. This is about you and your brighter future. So claim your free copy of the Laser Fund now. Understand and read stories and see examples of strategic rollouts, and you will be blown away on how we have saved some people $250,000, $500,000, $750,000, one couple, $1.2 million of unnecessary tax on their IRAs and 401ks.